leads Fisher Asset Management Fund managing $211 billion. One of the first investors to focus only on growth stocks. Writes engaging columns for Forbes, the investor magazine. Yes, I'm talking about Kenneth Fisher, a prominent investor figure.
Corporate earnings for a good long time have this tendency to do better than expectations, because what managements typically do is try to talk down the expectations so that they can beat the expectations.
Welcome to the Invest with Jiri channel. Today we'll take a look at the investment performance of Kenneth Fisher and his fund. Look at how he picks stocks, what investment styles he uses in investing, and how he has used controversy to generate interest in his hedge fund and financial advice. Are you ready? Here we go. The performance of Fisher's investment style. For the performance of Fisher's strategy, we can look at his Fisher Asset Management Fund. The StockCircle.com website shows the sectors farm invests in. We have the highest ratio of investments in technology at over 35%. Other sectors are represented at around 10%. Consumer discretionary, finance, other, healthcare, industrials. Sectors with 5% are energy, consumer staples, materials. What stocks does Fisher buy for his farm fund? The 5 largest positions are in Apple, Microsoft, Amazon, Alphabet and the Vanguard ETF. The positions range in size from 2.8 to 5.3%. What's interesting is the appreciation in the first 4, which ranges from 100 to 280%. Just for the interest, let's take a look at the biggest wins tab. Here we see that in Q2 2020 the fund sold 10,000 shares of Atlantic Energy Solutions with an appreciation of whopping 24,900%. What is farm's performance relative to the broad S&P 500 index? Fisher Asset Management boasts a 10-year performance of 43.92%, equivalent to 4.4% annualized. If we compare this to the S&P 500, which has had a 10-year performance of 172.2% over the past 10 years, which equates to 17.22% annually, this is a 12.8% difference in favor of the S&P 500. How did Fisher fare in the market movement estimates in the Forbes column? Fisher performed interestingly as a private investor in his columns for Forbes magazine. In this case, he achieved a return that was 24% higher than the return of the S&P 500 index in 2009. The following year, he achieved a final return differential of 5%. Also a good result. How does Fisher pick stocks to buy? His stock selection is based on using the PS ratio he describes in his 1984 book Super Stocks. Compared to the PE ratio, he says, this ratio is less affected by contingencies such as large investments, change in accounting methods or high research and development costs. Larger companies generally have a lower price-to-market ratio. Positive surprises often result from stocks with a price-to-market ratio of less than 1. Fisher prefers to buy stocks with price-to-market ratios below 0.75 and generally avoids stocks with ratios of 1.5 or higher, but certainly does not exceed 3. Another indicator is the debt-equity ratio, where debt should not exceed 40% of equity. Sector differences for stock valuation. Different sectors have different characteristics. Basic industries such as steel, engineering, automotive tend to grow more slowly and often do not generate large profit margins. This is reflected in the lower popularity of stocks among investors and is reflected in the lower price-to-market ratios. If the ratio is below 0.4, this could be an interesting opportunity. Stocks that meet these basic criteria receive attention according to the Fisher method. However, super stocks must also meet the following criteria. Long-term EPS, earnings per share growth, adjusted for inflation, should be greater than 15%. Free cash flow per share greater than 0 and 3-year average net profit margin greater than 5%. Over the course of his career, Kenneth Fisher began to focus more on qualitative characteristics of companies. such as the company's strong market position, competitive advantage, or taking into account the quality of the brand and its impact on customers and market position. In evaluating medical and technology stocks, Fisher uses the price, research and development, abbreviated as P/C/V ratio. This is a non-traditional approach. This ratio is based on the fraction of a company's market capitalization and R&D spending. Fisher considers a ratio below 5 to be a bargain. Fisher tracks fashionable investment styles. His analysis of stock returns between January 1976 and June 1995 suggests that different investment styles dominated during different time periods. Fisher identifies 6 of these styles. 3 focus on value stocks, large, medium and small firms, and 3 focus on growth stocks, large, medium and small firms. The most popular investment style outperforms all others. Fisher chooses to diversify between the styles. In order to increase the probability of a successful investment style choice, Fisher chooses 4 different styles at a time. By selecting multiple styles at once, he reduces the risk of making a poor choice that would impact the entire portfolio. He uses the international yield curve to determine the successful style. This is the difference between short-term and long-term interest rates. If the global yield curve is flat, usually rising, this indicates a period of growth in equities. When the yield curve becomes steeper, a shift to value stocks is needed. This is compounded by the evolution of global GDP and inflation. Another interesting feature is the tracking of the presidential cycle. In the first 2 years of a 4-year presidential term, there is a deterioration in trend of stock performance compared to the last 2 years. This is due to significant changes in the direction of the country, new policies, introduction of new taxes, etc. Investors are waiting to see what direction the situation will take. How to maximize your business? Kenneth knows all about it. To reach as many potential investors as possible, Kenneth is willing to make controversial statements. His unconventional approach to advertising and promoting his business is often shocking, and his marketing campaigns and statements often spark controversy and backlash in the media and investment world. But it works. One of his most controversial statements was his criticism of women in investing. At the Money Show conference in 2018 he said, "When you look at women, you say, can I see this woman across the room for the next 20 years? If she is your wife and the mother of your children, well, that's a long-term bet. Buying and holding long-term is the best strategy for the woman who is the mother of your children." This statement has been criticized for sexism and simplistic view of investing for women. Fisher also used controversial metaphors in his advertisements and promotions. 3 things that can make your wife fat: money, love and money and love. These campaigns were apparently designed to attract attention, but also caused controversy because of their provocative nature. Who is Kenneth Fisher really? Born in 1950, Kenneth Fisher is an American businessman, economist, investor and author. Kenneth has gained widespread attention for his unique perspective on financial markets and investing. Fisher studied economics at Stanford University and soon became involved in the family business, which he later left for a career as an investor. He has summarized his knowledge and views on investing in several books. Super Stocks in 1984, The Wall Street Waltz 1987, 100 Minds That Made the Market 2007, The Only 3 Questions That Count 2007 and The 10 Roads to Riches 2008. That's all for today. I'm glad you made it to the end and I look forward to seeing you next time. Have fun and invest wisely.